Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking how to choose the perfect insurance excess and save hundreds every year today, and tying it back to the wider cost saver ecosystem, including tools like Insurance Excess Calculator so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
All right, so welcome back to MoneyWise UK, the podcast where we try to make sense of all the financial stuff that honestly keeps us up at night. Today, we're diving into something that I think most of us just kind of wing it with: insurance excess. And here to help me not sound completely clueless is our resident money guru, Assad. Hey.
Hey, Angela. Yeah, no, you're spot on, actually. Insurance excess is one of those things where people just pick a number and then that's it for the next 5 years, right?
Guilty as charged.
We all are. But look, my neighbor Sarah, right? She discovered she'd been basically throwing away 240 pounds a year, every year, for 3 years.
Wait, what? How?
She'd gone for the lowest excess option on her car insurance, thinking it was the safe choice. Which, I mean, fair enough, that's what you'd think. But here's the thing, she hadn't made a single claim in 5 years, not one.
Oh, wow. So she was paying for protection she wasn't even using.
Exactly. And when she actually ran the numbers, well, we've got this calculator thing, she could have saved 240 annually just by adjusting her voluntary excess. That's a weekend away, you know?
That's mental. Okay, so, and I'm going to sound really basic here, but what actually is insurance excess? Because I feel like I should know this properly by now, but
No, it's actually not that straightforward. So, basically, it's the amount you pay towards any claim you make. It's like your contribution, your share of the risk.
right.
And in the UK, we've got two types. There's compulsory excess, which the insurer sets. You can't change that one. Young drivers, oh man, they get hammered with this. Often 500 or more just as compulsory.
Ouch. That's before they even choose anything?
Before they even choose anything. And then there's voluntary excess, which is the bit you actually control. You add that on top of the compulsory amount. So if you've got, say, 250 compulsory and you choose 500 voluntary,
You're on the hook for $750 if something happens.
yep. And here's the kicker that people miss. It's per claim, not per year.
Oh, I definitely thought it was like an annual thing. Like you pay it once and you're covered for the year.
Nope. 3 claims, 3 payments, which is, yeah, it can add up fast.
That's actually terrifying. So why would anyone choose a higher excess then?
Well, that's where it gets interesting. For every 100 pounds you increase your voluntary excess, your premium typically drops by somewhere between 5 and 15%. Motor insurance gives you the biggest discounts usually.
Okay, but like, can we talk real numbers? Because percentages always make my brain just,
Yeah, fair. So let's say you're a 35-year-old in Birmingham, clean driving record. With 250 pounds voluntary excess, you might pay 680 pounds a year for car insurance.
okay.
Bump it to 500 voluntary, that drops to 590. Go to 750, you're looking at 540. And if you're really brave and go for $1,000,
1,000 pounds?
you could be paying just 510 pounds annually. So that's a $170 difference between the lowest and highest.
Right, but I mean, you have to actually have that 1,000 pounds sitting around if you need it.
Exactly. And this is where people mess up. Because look, only about 15% of drivers make a claim each year. For homeowners, it's even less, like 12%. So most people won't claim, which is great, but
But when you do need it, it's usually at the worst possible time, right?
oh, always. Your boiler breaks in January, right after Christmas has cleaned you out, Or your car decides to give up the day before payday, and suddenly that $500 you saved by choosing high excess, you're scrambling to find it.
Ugh, I can feel the stress just thinking about it.
Right? So honestly, the golden rule, and I really can't stress this enough, never, ever choose an excess higher than what you've got in your emergency fund.
That seems really obvious now you say it.
It does, but you'd be amazed how many people don't think about it. They see the premium saving and just,
Click, yeah. So, how do we actually figure out what's right for us then? Because everyone's situation is different, right?
well, yeah, it's super personal, but there are some things to look at. First, your claim history. Have you claimed in the last 5 years?
Um, Actually, no, not once.
Right, so you're probably a good candidate for higher excess. But someone who claims every couple of years, they should probably stick with lower amounts, even if the premiums hurt a bit.
Makes sense. What else?
Your financial buffer, obviously, and just your general risk tolerance. Some people genuinely sleep better knowing they won't face huge bills. Others are fine rolling the dice to save money month to month.
I'm definitely in the sleep better camp.
Nothing wrong with that, but there's also a mathematical way to look at it, the break-even point.
Oh, this sounds proper mathsy.
It's actually not too bad. Okay, let me use an example. You're choosing between 250 pounds and 750 pounds voluntary excess, right?
Mm-hmm.
The premiums are 680 and 540, so you're saving 140 pounds a year with the higher excess. The difference in excess is 500 pounds. You divide 500 by 140,
Which is, 3 and a bit?
3.57 years, yeah. So if you claim less than once every 3.5 years, the higher excess saves you money. If you're claiming more often than that, stick with the lower one.
Oh, that's actually really helpful, like a proper formula to work it out.
Right? Takes the emotion out of it. Though, I mean, it assumes your claims are always above the excess amount, which for car insurance they usually are, but
But not always. I hadn't thought about it like that. Does this work for all types of insurance?
sort of, but each type has its own quirks. Like with car insurance, experienced drivers can usually handle $500 to $750 voluntary excess no problem. But young drivers, they're already facing massive compulsory excess, so adding more is just…
Asking for trouble.
Exactly. Home insurance is different again. The premium differences are smaller, often just $30 to $60 annually between minimum and maximum options, not as dramatic.
So less incentive to go high?
Well, it depends on your property. New build with warranties? Yeah, go higher. Victorian terrace with dodgy plumbing and an ancient boiler? Maybe keep it low.
Oh God, that's literally my house. The boiler makes these sounds.
Yeah, then definitely keep that excess manageable. Oh, and some insurers let you have different excess for buildings and contents.
Really? So you could go high on one and low on the other?
Yep, maybe high on buildings if you're confident in the structure, but low on contents if you've got valuable stuff.
That's clever. What about pet insurance? Because I know that's a whole thing.
Oh, pet insurance is weird. Most policies charge excess per condition per year, not per claim.
Wait, what's the difference?
So if your dog gets arthritis and needs ongoing treatment, you only pay the excess once that year for all the arthritis claims, not every single visit,
Oh, that's actually way better than I thought.
right? So for young, healthy pets, you can probably go higher on the excess. But older pets or breeds that are prone to problems, I'd keep it low. Vet bills are just…
Astronomical. Yeah, so what about actually putting all this into practice? Like, where do we even start?
Okay, so first thing, and this is going to sound really boring, but audit what you've got. Get all your policies out, check your current excess levels, your premiums, when they renew.
The fun Saturday night activity.
I know. But also, check your claims history. Most insurers have it online now. See how often you've actually claimed.
And then?
Then be honest about your finances. What's your real emergency fund? Not your savings for a holiday or a new kitchen, your actual accessible emergency money.
Which for most of us is not as much as we'd like.
Exactly, and that's fine. Just be realistic about it. Then you can run those break-even calculations we talked about.
Should we change everything at once?
God, no. Start with one policy, probably car insurance, since that usually has the biggest savings potential. See how it goes. And here's a tip. Put the premium savings into a separate account.
Oh, like an excess fund.
Exactly. After a few years without claims, you'll have built up enough to cover even a high excess comfortably.
That's actually brilliant. And I guess we should review it regularly?
Annually, at least. Your life changes, right? New job, kids, divorce, retirement. All of that affects what excess you can handle.
What are the big mistakes people make with this stuff?
Oh, loads. The biggest? Only looking at the premium savings. Saving 200 pounds a year sounds amazing until you suddenly need to find $1,000 and you just can't.
Been there. Not with insurance, but yeah.
Also, people forget about their compulsory excess. They'll add 600 voluntary on top of 400 compulsory, and suddenly they're looking at a 1,000-pound bill if anything happens.
1,000 pounds. That's rent for a lot of people.
It really is. Oh, and here's one that catches people out. Claims can cluster.
What do you mean?
So, say you have storm damage. That might be a claim for your roof, another for water damage inside, another for ruined furniture. Each one could trigger a separate excess.
No way. So one storm could mean paying excess 3 times?
Potentially, yeah. Depends how the insurer structures it, but it happens. It's why you really need to read the policy properly.
That's actually quite scary. And with everything going on economically right now, inflation and all that.
Yeah, it's tricky. Premiums have shot up. Car insurance went up over 20% last year alone. So the savings from higher excess look really tempting. But at the same time, everyone's emergency funds are, well, they're not what they were.
It's a real squeeze, isn't it?
It is. And look, with interest rates where they are now, you could be earning 5% on savings. So paying an extra 200 pounds in premiums actually costs you 210 when you factor in lost interest. It all adds up.
My head's spinning a bit. What are the absolute key things people need to remember?
Sure. Okay. Never choose excess higher than your emergency fund. That's number one. Always know your total excess, compulsory plus voluntary. Use that break-even calculation to see if higher excess actually makes sense for you based on your claims history.
Right.
And review it every year, especially after big life changes. Don't just set it and forget it for 5 years like most of us do.
Like we all do. Assad, this has been genuinely eye-opening. I'm definitely going to check mine this weekend.
Do it. You might surprise yourself with what you save.
Or scare myself with what I've been wasting. Thanks so much for coming on.
Anytime, Angela. Always happy to talk about the exciting world of insurance excess.
The glamorous life we lead. All right, everyone, that's it for today. Go check those policies. Quick side note. This guide connects with other cost-saver blogs, especially optimizing home energy efficiency.
Exactly, and reading those together gives you a fuller picture of safety, energy costs, and long-term affordability before you choose a postcode.
And if you want to apply this immediately, jump into tools like Insurance Excess Calculator right after this episode.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone house hunting so they make safer and smarter money decisions.
Your next step is simple. Try Insurance Excess Calculator, then read Optimizing Home Energy Efficiency, and use both together before committing to a move.